Top 7 investing tips for beginners in shares or ETFs. Shares and exchange-traded funds, ETFs, are ideal for beginner investors due to their many benefits such as low expense ratios, abundant liquidity, range of investment choices, diversification, low investment threshold, and so on. These features also make them perfect vehicles for various trading and investment strategies used by new traders and investors. In this episode, we'll be walking you through the top 7 tips you should adhere to if you want to succeed as an investor in shares and ETFs. But before we get started, don't forget to hit that subscribe button so you don't miss the future episodes about investing in shares and ETFs. Let's get started. 1. Patience is key. We've observed in recent years that people are obsessed with making money fast and in fact often feel entitled to it. This is clear from the number of new investors who join the market and expect to be making thousands of dollars in a matter of months. With investing, patience is key. If you're looking to make money fast, you'll likely be investing in volatile shares that can lose you money as quickly as you gain it. There are certain individual companies that you can invest in or buy ETFs to make a decent profit. ETF stands for Exchange Traded Fund, and they offer you a way to invest in a wide range of bonds or shares in one package. They'll typically track a specific market, like the Financial Times Stock Exchange FTSE 100, a fund containing the 100 largest companies listed on the London Stock Exchange. With ETFs, you're investing in a small piece of every constituent company in the fund, meaning there is less risk to you. If the stocks in one company suddenly drop, it will have far less of an effect on the money you've invested in the ETF than if you invested in that company alone. The downside of ETFs is that there is lower risk. There can be lower rewards. This is why you need to be patient. The S&P 500, a stock market index of the 500 large companies listed on stock exchanges in the United States, had seen an annualized return of 10% since inception. This might appear slow if you're addicted to checking the value of your portfolio every day. However, by continuing to put money into a fund with an annual return of approximately 10% will award you with a nice pot of money long term. 2. Don't follow the herd. Do your own research. We cannot stress enough how important it is for you to do your own research and understand what you're investing in. When you hear or come across a term or language that you do not understand in the investing market, make the effort to educate yourself on it. You cannot be risking your money if you do not completely understand what you're doing. Start by reading articles for beginners and watching videos on YouTube. There is so much information out there, and you can gradually build up your knowledge on investing in stocks. Do not only take someone else's advice and invest in what someone else tells you to. Understand your expectations and research what investments might suit you best. Avoid jumping on the bandwagon because you see people online investing in certain companies or funds. This is your money at stake. You need to understand what you're doing with it. If you profit from your investment, you may be subject to capital gains tax. Educate yourself on your country's rates and exemptions. 3. Diversify your portfolio. The first piece of advice you should adhere to is to diversify your investment portfolio. It's important for you to have an understanding of everything you're investing your money into. As you continue to learn, you can add more markets to your portfolio. Choose areas that interest you. You're more likely to track their progress. For example, if you have an interest in green energy, then invest money in that sector. Try and learn about sustainable energy sources and believe it is something that will continue to become more popular over the next decade. Do not invest in something you do not understand. While diversifying your portfolio is important, remember that many online stockbrokers charge fees each time you buy shares. For this reason, avoid investing small amounts of money in different companies and funds at one time. Try to invest a few $100s in one fund each month in order to only be charged one fee. Educate yourself on the fees you may be exposed to. 4. Do not panic sell. When the market is down, it's really difficult to see your stocks reduced to a lower price than what you previously paid, but do not panic and sell them. In fact, buying shares while they're down can be advantageous. The stock market is volatile, and it's no secret that long term there will be highs and lows, but you have to stick it out. Selling while the market is down is a sure way to lose money. In March 2020, hundreds of company shares rapidly decreased due to the pandemic. Some people thought the stock market should be avoided at all costs at this time. See this period as an opportunity to buy shares at a low price in companies that you believe will be able to bounce back once COVID-19 has been controlled. It doesn't take a pandemic for shares to drop, but when they do, think before you start selling. The market always recovers. Reap the long-term rewards by sitting tight. 5. Don't wait, just start. Most investors usually regret not starting earlier. If you have any disposable income available to you at the end of the month, then start investing it. You should have your money working for you, not sitting in a bank account gaining next to no interest. Of course, it's important to have a cash reserve and savings for upcoming expenses, as well as a rainy day fund for the unexpected. But if you have decent savings, then consider starting to invest some of it. Many believe there is a huge risk involved with investing, but as mentioned, there are options available to you that are low risk and can give you great returns long term. If you have a portfolio with 10.2% growth per year, then investing $200 a month will make you a millionaire in 40 years. Sure, it may seem like a long wait, but for one, over time you may be able to start increasing your monthly investments, and secondly, who needs to wait to reach $1 million? Plenty of us would be ecstatic to see that number hit even $500,000. 6. Use a robo-advisor. You can also look into investing with a robo-advisor. A robo-advisor is a digital platform that uses algorithms to assist you in choosing and managing your investments. A robo-advisor provides many of the same services as a full-service account manager, but in the place of the human advisor is software. Don't worry, it's not all about software and robots. Robo-advisors still staff humans to design the algorithms, answer your questions, and help you out. Betterment is a good robo-advisor to start with. Betterment charges an annual fee of 0.25% on your balance in any investment or retirement account. This works out to $25 per year for every $10,000 you've invested. Plus, Betterment accounts do not require a minimum balance. 7. Understand factors that impact the financial markets. Before investing in financial markets, you need to first understand the factors that influence its movement. Financial markets include stock exchanges, foreign exchanges, bond market, money market, and the interbank market. These are essentially a marketplace for financial instruments, and like any other market, they function on demand and supply. Like any other market, there are also external factors like interest rates and inflation that influence its dynamics. The other major influence is the central bank and its monetary policies. You don't have to be an expert to start investing in stocks, and you don't need a financial advisor unless you happen to have a lot of money hanging around. Learn the basics, take your time, and be proud of yourself for making your hard-earned money work for you. And lastly, don't expect to be overly excited when you get into investing. You aren't gambling in a casino. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck, and see you in the next episode.